Good morning, everybody. Um, I'm sorry I have again problems with my video camera. I will try to fix it later on, but at the start you will not see me. Um, I hope you're fine, and please take a short poll. Oh yeah. I just remind that I sent you an invitation to Google Classroom, and as far as the code itself, to join the other way. So just let me know whether you managed to join the Google Classroom. Have you seen the materials? Have you started to read them? In case you have problems, please let me know and don't hesitate to drop a line in the chat. We will gradually start. Um, Please, those who joined, don't forget to take a poll. It will help us. And today it's a week 4, and here is our basic structure of the course. So the major focus of today's lecture will be the venture capital deal itself. We will cover different aspects and major topics. The last lecture, which is supposed to be in a week, maybe we will shift it a little bit. It will be majorly focused on valuation itself. However, we will touch the valuation today slightly as well. This is the agenda of today's. I'm sorry, yes, it's not required for agenda. Actually, first, before going to the deal itself, we will try to understand first of all where actually high discount rates in venture capital come from. As far as you remember, all venture capital firms and managers, they on on average they expect high returns, high multiples, high IRRs, and first of all we have to understand the idea where it might come from. Um, Next, we will go to the deal, and first we will touch the deal philosophy itself. We will consider the term sheet, what it is, why we need that. We will cover major types of securities which are used in the deal. We will slightly touch the valuation aspect. Actually, we have already done that, but we will remind ourselves again. We will talk a little bit about legal documents and their role in the deal. I will summarize it in some deal terms in diagrams, which not mine, but I like them. I hope you will like them as well. And then in the end, we actually will focus on more technical things closer to calculations and things like that. And we will understand how particular deal terms might work. First of all, anti-dilution. Remember, it's when we have a term which prevents uh, us from being diluted if in case we are the previous investor and the next investors actually buying in the company at lower valuation, not higher. We will deep dive in convertible note and how this thing works. This is actually quite interesting topic, I would suggest. And I will try to show you some actually impacts of selected deal terms. And actually, today it will be liquidation preferences. Um, yeah, thanks for actually answering the poll. We still have a couple of people to answer. Okay, I will leave it open. So please just fulfill it and we just continue. And first of all, let's answer the question where high discount rates in venture actually goes from. It's rather general, but it will help us to comprehend the things we need. Okay, first of all, when we compute net present value, actually in general corporate finance, right, we assume that there is 100% probability of particular cash flow stream. And as far as we understand, it's not usually true, right? And it works like that. In case you invested in a project or in a company, you have some probability of success, which is P success here. And you might get some cash out after you have invested. But in the same time, you have the possibility of zero. And of course, it's 1 minus P of success. And let's look at that in numbers. So the formula would be NPV equals minus cash in, but then you have to cash out, multiply by probability of success and discount that. Equivalently, it will be slightly different, right? So you will leave cash out on the top and you will take the P of success down of the equation. And if you do it correctly, note this particular part of the formula. This is how it will work in venture. So 1 plus IRR to the power T, it's actually 1 plus required venture, 1 plus required capital of venture strategy, but you have taken into account the probability of success. And equivalently, the formula will tell you that IRR equals -1 plus this difficult formula. Let's suppose that we're a conservative venture fund investing, I don't know, late stage, or just an example, 10% required on the portfolio level return, which is not very high. It's, I would say, relatively low, but still, as far as you remember, not many funds actually capable of doing even 10%. And let's assume that the probability of success of our investment into the company is only 20%. And we have to make an exit in 5 years. So what this formula actually give us? It will give us more than 50% IRR. So actually, if I'm making an investment from the fund, which in aggregate requires 10% IRR on a pool basis, and if I'm investing in particular company, which I assume have the probability of 10-20%, and I want to get out in 5 years, it tells me that I have to discount the projections of the company, etc. So my actually required return for particular project would be more than 50%, almost 52. This is where actually those high IRRs are coming from. Just that's the logic. And of course, they might be even higher in case the probability of success are assumed being lower, right? 10%, etc. And if you try to put this onto the graph, you will see that increasing the probability of success actually is taking you closer to your required return. The most right point on this graph actually shows you that if the project has 100% probability of success, it's enough for you to require only 10% for this project. But with probability of success decreasing, you should require disproportionately higher return or discount rate, which you should use when you discuss valuation. All right, so in the end, you will be discussing the exit point, which will be in 5 years time period from now. And you will be discussing the valuation today when you will be trying to make an investment. And if you think that probability of success of this particular project is relatively low, you will be requiring high discount rate or high IRR on your investment. So that's in a nutshell. Actually, I hope that was clear, and it actually very good reconciles with the total idea, right? For mature firms, the cost of capital is lower, right? And the less the risks are of the company, the lower the discount rate. So actually, the whole logic of corporate finance is okay here. Okay, let's move on. Now we actually move to the deal itself, and it will cover several topics today. And first of all, let's try to answer the question why actually the deal terms, here is called these terms to make the letters bigger, why the terms of the deal are important. And this is the figure from one of the white papers. That's the source to the bottom. Actually, you can Google that and read if you want. But the major point here is the skewness of distribution of returns. As far as you can see here, the most of your investments, actually two-thirds, will not return you money. Part of them, the biggest part of them, will actually lose you money. Then only one-fourth of them will provide you with 1 to 5 multiple. And you can continue this conversation. So actually, you have only few investments which provide you huge returns. In this situation, it means that in most cases, in terms of number of investments, you will end up trying to get less together with other investors and founders from the company, so the most left bucket. And it will all depend on the deal terms, who will get more and in what sequence. The short answer will be the deal terms are quite important because in most situations we have to split the pie which is smaller than it was. And this is one of the good phrases I actually like. It's by James Hirschwiller. As far as I remember, he is a part of Common Angels Network. And what he says is that oftentimes the best deal actually is the deal in which each party actually feels like they could have done a little bit better, but nobody got everything they wanted. So there was some kind of compromise, and everybody will fine with that. Okay, now let's move on and discuss actually what the deal is. Let's try to slightly discuss and be philosophical first. The deal is an economic agreement between different parties. And in a nutshell, actually, it involves the allocation of three major things. It's cash flows, and it's both amount and time when the cash flows go into the project, out of the project, and in what sequence. It's the allocation of risk. As far as you remember, risk might be not equally split, and it's the allocation of value itself. What is interesting that deal is actually subject to interpretation by the parties. So different parties might see the deal differently, and this actually helps the deal to be done, right? And the basic structure of VC deal actually driven largely by the key objectives of VC fund who are an investor, right? And its managers. As far as you remember, VC firm managed other people's money. They have to take $100 and give back more than $100. At the same time, they need to make money for themselves. So the financial component as a motivator here is quite high. There are four key considerations which actually motivate the venture firm and the VC investment structure in general. First of all, as far as I mentioned, that's maximizing financial returns. Right? The more we have in terms of money, the better, and the more successful we are, the more carried interest we have, the bigger the next fund will be, the faster it will be closed. The another thing is the priority protection against losses. So in ideal situation, venture firm investing in the project would be the first to take money out and the last to bear any risks. That's ideal situation, almost impossible, but at least that's the direction in which they will try to negotiate around the deal. Also, VC firms, they want to participate in management of the company and the potential control, as well as some exit rights. So they want to discuss the exits at the start of the deal. They want to put on the paper some particular things they want to see in the negotiation, in the deal, in the documents. And in the end, it's again about maximizing financial returns, being able to get out, not bearing any risks, or join those who are bigger, stronger, if they make the exit from the company. Main actually issues between the founders or entrepreneurs and venture capital investors are usually set forth as they say in a term sheet. Actually, the term sheet serves as the basic framework for investment and proper deal documentation. It means that we first of all agree on major things verbally, as let's say you're a founder, I'm an investor. We put that on paper as a bullet points, as a presentation. It actually not a presentation, but it's term sheet, but it's several pages of text only. Um, Quite often in terms of like a table. On the left you have the name of the particular aspect of the deal, and to the right you have more details. But still, that's more like bullet points, things we agree upon, and this thing after that is used by legal by lawyers. Um, it's important to note that there are several inherent conflicts of interest between entrepreneurs as users of capital and investors as suppliers of capital. I'm sure you know about them, but let's just go through them. Actually, entrepreneurs want as much capital as possible, and while investor actually wants to provide just in time, and when the company really needs that money, and in stages or in pieces or in tranches, right? You as an owner of capital in a deal situation will just give money just in the moment when the company need that, and just in amount it needs, no more, because you can use it anywhere else. The approach of entrepreneurs is usually my price your term versus my price and my terms of investors. Let's be honest, investors a little bit better prepared for such things. But entrepreneurs who are serial entrepreneurs are also good counterparties. There is also in entrepreneurs independence versus investors control aspect. And it becomes even more important in case when the company doesn't perform well, right? If expectations are not met, expectations of investors and sometimes entrepreneurs, things should be changed somehow. Some major, I don't know, restructurings or I don't know, change in the team should be done, and that's usually another point of conflict, and you better agree on that before it happens. All right, and you better agree that during the deal, you put that in term sheet and then in documents. Interesting point that long-term goals of users and suppliers of capital, that's another problem. I'm sorry. So that was another page. Yeah, okay, let's go to the third point here. It seems like a technical problem yesterday. Actually, what is important in addition to what I have mentioned already, that's actually the entrepreneur's flexibility in decommitting from the project and actually trying to capture or seize new opportunities. What investors want, they want the entrepreneur to stick to the business plan, to be fully committed for many years for particular projects and make money for investors, right? Entrepreneurs are people, and from time to time, they find themselves in a situation that they don't like the project anymore, or they want to switch, or they want to pivot. Pivot means to totally change the approach or direction of the business or efforts. And it's the point when again investors and founders might be in a conflict. And from time to time, there are types of entrepreneurs or founders who actually don't want to increase the company in size and value very fast. Remember, we touched that in founder's dilemma. There are people who want to control, but in addition to that, they want gradually build the company and gradually cash out. So actually, to make a project which will provide you money for living, big money for living, not huge, but enough, even more than enough. But that's not something investors actually want, right? They want the business which will grow in size very fastly, will increase in value many times, and they will exit. So this is again another area of potential conflict of interest among the founders and investors. Okay, let's move on. There are things which are very important. If you don't know the details of the deal, you get what you deserve, right? Not what you want. This phrase, I like it very much because on both sides, both investor side and even more on the founder side, if you don't read all the papers, if you don't understand how everything works in different circumstances, you might get in trouble. And entrepreneurs cannot rely on attorneys, advisors, and lawyers to protect them. Actually, the devil is in the details, and you have to look at those details. On the other hand, the VC investors are not bad guys, right? They can add a lot of value to venture firm. I'm sorry, to venture project. As far as I remember, I've showed the pie, and most of the startup founders answered that VC was of help. But still, things can be different, right? And situations can be different. The best thing you, as both founder or investor, can do is to prepare, to understand, to make your homework, and to make a deal which you understand in all circumstances. So no major surprises for you, whoever you are. Now let's discuss some pre-investment and post-investment considerations. So before you investing into the company, you have to consider lots of aspects of the project, right? And first of them is, of course, the business plan. You should try to understand what is this business about? What is the market? How addressable is that? Remember, we touched that slightly already. And whether the business plan is so-called coherent. So does it make sense in general and among the different parts of that? Is it fairly complete, or it's just some, I don't know, notes on the paper? Is it readable? Interesting enough, but is it something you can read easily and I don't know, present to anybody else? Or, I don't know, tell about that. The business plan should be able to demonstrate the capabilities of management team to plan and organize the business. It's not even actually the numbers are not that important themselves. The projections, of course, will miss the facts. Usually they are too high. Sometimes they might be actually too low, and the success might be even better, even bigger. But what is important for you as an investor in the business plan to see that the team can put it all together in one place, and it all makes sense. And they can plan, they can organize the business. At least they try to make those, I know, those directions, those roads where the project will go to. The business plan, a lot of things here we might discuss, but in general, it might be, it should be complete, it should make sense, it should be clear, it should show you the abilities of the team, right? It should provide actually the basic set of assumptions which are quite important for you to know about as an investor, because your assumptions from the market and particular projects like that might be totally different. They might be better, they might be worse, they might be somewhere in between. But still, you have to get all the data you need, all the information you need from the business plan, and plus the conversations with founders to make your own opinion about the project, about this particular business idea. What is even more important, the business plan might become the so-called benchmark for important milestones. Remember, venture firms, they go from milestone to milestone, and actually they need money to go from one milestone to the next milestone. For instance, I don't know, to finalize the beta version of the project. Then you take money, you go into the market, you put some market, you have some marketing costs, you test the hypothesis, you try to understand the acceptance of the product or service in the market. If it's successful, you ask for another chunk of money for next steps, and so on, so on, so on. So actually, the business plan can show you this more or less this path. Next thing is actually intellectual property rights. Primary intellectual property rights like patents, copyrights, and trade secrets, they must be clear and protected. Of course, not in all businesses this is important, but for sure you understand that it's becoming more and more important, and in particular areas of the industry, particular industries, that's actually part of the success. And if in the latter case you have to check all those things, right? Together with lawyers and people, specialists, this is must be done. What is even more tricky, when you provide the venture company with the funding and it is making some new patents or trade secrets or IP rights in general, it should be the company who owns them, not the founder, not executive or third party. It's a stupid situation, not very often met, but generally you have to understand that the money goes for making IP rights and they are the property of the company, not anybody in the company. There should be some non-disclosure and invention assignments agreements, which says that um, in general they say that those new things invented into the company, I don't know, they should stay into the company. No trade secrets should go out. If people go out, they should sign some non-competition agreements, which is the next point. For instance, if you are making an electric vehicle somewhere in the Google or Apple or Kia at the moment, and you live in the company, most probably you have already signed the paper that you will not be able to work for competitors. And the companies in hot markets trying to actually increase this barrier for entry or increase this barrier for leakage of information of IP rights and some very, very important knowledges. And relationships of key employers with prior employers, that's something what might be also regulated. So in general, it's a little bit, I would say, boring to do these things, maybe to listen, but remember, calculations and numbers and money on accounts is just a small part of deals and business. And you just have to be very good in those things to be successful founder and investor. The next point of before you are investing in a company, it's actually the history of the company. And the best situation is when the equity interests are held by the founder, key management team, and small group of people. Prior agreements actually should not grant special rights to any group of stockholders. If this is the case, usually new investors, newcomers will try to renegotiate that, to change that, to amend the charter holder of the company, or I don't know, avoid some previous agreements, just to equalize the previous investors with the new investors, and even more to make new investors higher in the capital structure than the previous investors. Otherwise, there is no sense for them to invest. Remember, in venture funding, usually, not always, but usually, last money in, first money out. This is how it works. So the next investors who actually buy the company at higher valuations, they have so-called liquidation preferences. And in case the business is going, I don't know, is being sold but not nicely, there are problems with some calculations or the pie is becoming lower, they first will take money out and only the remaining part will be split among previous investors. But we will touch that today, I would say, to show you all the nuances. All prior issuance of equity interest or just issuance of stocks, right, they must be properly documented and reviewed. You should see the clear picture of who, when, and how many stocks acquired, and to understand the full picture of capital stock and your potential dilution. So no surprises in the future for you. That's your goal. And to align the interests of the team and stockholders and founders, you better have the situation when key employees are like so-called vested into the interest, which means they have vesting agreements and their stocks are not their stocks already, but their stocks will be becoming their stocks with time. Right, so when they have to work for the project for several years, usually it's 3 or to 4 years, and you have so-called vesting when with each month you get a piece of your stock. And actually there is a restriction on transfer of rights. It's for you, it's quite important as a new investor that the previous investors or other investors cannot easily sell their stakes into the company. It's not stock exchange. You're not trading Gazprom or Apple or Tesla and just buying and sell it when you want. No, it doesn't work like that. There is so-called the right of first refusal. in favor of the company or sometimes in favor of other shareholders. So let's suppose you are one of the founders or key employees, you want to go out. You cannot sell your shares to somebody else, to the third party. You should first propose it to current stockholders, and sometimes if they are not buying, the company just buy out and proportionately, actually, effectively proportionately, or everybody is buying this stocks. And there are some other pre-investment considerations which might be even more boring, but might have even bigger consequences. They first of regulatory matters, and they're becoming more and more important, especially in so-called ESG aspects, etc., and tax matters, which also becoming more and more important. And the tax matters are quite connected with the next one, which is cross-border considerations. As far as you remember, many companies, businesses, they're trying to play with different jurisdictions to, to decrease the tax leakage from the business. But with time, it will become even more difficult, and you have to take that into consideration when you plan for years ahead. Okay, now let's move to major points which we will touch upon today. So when we negotiate the VC financing, there are several most important points of discussion. First of them is, of course, valuation. That's the most important issue. Um, and you should calculate that on a fully diluted basis. So in general, two things: what is the valuation of the business, and what is my fully diluted share in that at the moment of the deal? When we say fully diluted, remember we should take into account all the potential options and stocks which will be fully vested, and etc. And amount and timing of investment is also the major point of discussion. Whether the business will take the money at once or the money will be provided in installments or in tranches. Whether the money will be provided only on achievements of milestones or it will not be somehow connected, or it's just timing. Not regular, but still things to keep in mind, things to clear before signing. And the form of investment by the venture capital firm, what types of instrument actually will be used? Will it be convertible preferred stock? Will it be participating or not participating? Will it have liquidation preference or not? Will it be paid in kind? Will it have paid in kind dividends or not? In any other debt notes, any options, warrants? Don't worry if you don't get clearly all these things. We will try to cover them today, at least most of them. But just for you to get the flavor, right? It's not plain vanilla common stock. When you invest as a venture firm, the situation at least slightly complicated, sometimes even more complicated. Next one is number of directors from the venture firm into the business. So why you need that? You need to monitor the business, right? You want to understand that the money which you invested into the company are properly spent, and the business is using them in the best way possible, right? Also, if you don't agree with particular aspects of management, you want to have your say in running business, right? You want to have some veto rights, have special rights. So it's all about protecting your investment and all about adjusting the trajectory of the business according to your expectations. Again, vesting of founder stock. It's not always the case, but still, there might be a situation when VC is coming into the business, but one of the terms is, okay, Johnny, you have your company. I will invest. I will take 20%. You will have your 80%. But this 80%, you have to work several years to have all your 80%. So effectively, I'm taking out your share into the company, and I'm giving you this share in pieces, right? Or it might be vested at time zero. It's all about negotiation, but usually VC firm makes this thing insist on the vesting if they want to keep the founder for years into the company, which is important, right? Any additional management members sooner or later will be added, and they will have a dilution effect in case they will be provided stock options, or etc. This should be negotiated in advance. And in a simple form, there should be equity share option pool. Whether it will be created before or after the deal actually impacts the dilution for investors. Protection of conversion rights of the venture firm from future company stock issues. And this is what we'll try to touch today. So anti-dilution protection, it usually have two-way, average weighted and full ratchet. And the idea of anti-dilution protection is simply the following. I have invested into the company. In the next round, it is the down round, the valuation is lower, and next investors actually buying stocks at cheaper price, right? And for me, it's a pain. And anti-dilution protection actually protects me from the full effect of that. It actually negates part of that. So the effect will be not so obvious. But in full ratchet, I will be fully protected, but it's rare commonly because there are a lot of money currently in the market. But at least some protection from dilution might be in place. And there might be also so-called pay-to-play provisions. It's when if you want to stay proportionally invested into the business, and you have to pay on next rounds. If you don't pay, you actually go lower into the capital stack. You are being diluted. And again, this is more obvious in case when the business is hardly hit or doesn't meet milestones. Just an example for you, a year and a half ago, or even a year ago, a lot of startups in travel industry, they were hardly hit. Some of them went bankruptcy. Some actually pivoted or were restructured. And during those restructures, new investors or current investors who provided the capital actually increase the exposure to the business. Those investors who have not invested additionally, they were actually diluted a lot. They mostly lost their exposure to the business. So they didn't pay, and that was almost over. Preemptive rights of the venture firm to purchase any future stock issues on a priority basis. This is also one of the important aspects. Let's say the company is making next round and it is issuing stocks in this round. You as an investor in, let's say, B or C round, want to be able to buy additional piece of company stock issues in round D. Other big funds, big names might come, and the demand for the stock might be huge, but still, if you have preemptive rights, you will be able to at least get something, right? So you try to avoid the situation when you are not participating in successful, fastly growing business. It's very important, right, to keep exposure to the growing business into your portfolio. Next thing which should be negotiated, that's the employment agreement with key founders, right? Compensations and benefits should be covered, duties of employers and circumstances for changes and circumstances to fire people. So you better agree in advance on those. What types of severance payments and in amounts of severance payments will be paid on termination, so to avoid any legal disputes. Legal disputes are quite often in Western world, so you better be prepared. So just legal lawyers should make a huge work to trying to avoid a lot of bad things after retirements and firing of people. And as far as I understand, firing people in startups, it's quite often. Happens quite often, right? Because not all startups are successful. Actually, most of them are not successful, as far as you have seen from the distribution of returns. And the rights of the company to repurchase the stock of terminated employee, and the price at what price it happens also might be quite important. The term of employment of those key people, and any restrictions on post-employment activities and competition. Remember, if valuable person from the startup is leaving the company, What you don't want as an investor is just this person making another team and starting a competing business in several months, right? Who understand everything, who knows your weak points, and etc. Um, the proprietary rights of the company, something what should be discussed as well. An exit strategy for investors, also very important for you. Whether it will be registration rights, there are so-called, there are different types of registration rights. Demand, piggyback, that's mostly Western world, but for you just to understand, when the company is making IPO, they should register the stocks for the issuance, right? And in those, not all stocks might be registered. So there might be a situation that some of the stocks are not registered while the others are registered. And the stocks which are registered only can be sold to public. So it's a legal aspect, but for sure the situation is to avoid the problem of your stocks not being registered, right? And there are different types of legal aspects here. Any co-sale rights, which actually allows usually smaller investors to sell their stake together with any sale of bigger stakes by bigger investors. So it helps you to avoid the situation when big investors into the company are changing and you are now together with other investors into the company. Maybe you don't like them. You don't want to work with them. Or if it's a big deal, if it's a validation of the valuation of the company, you agree to sell. So you want to have an option to just sell your stocks as well. And there might be stock redemptions under certain conditions, very rare, but still, let's say company have cash, have ability, and milestones are not met, so it redeems the stock. But usually it's not the case. Usually the businesses are cash negative. They need this cash for business development. But in some cases that might be an exit strategy. So let's say in 7 years, you say that in 7 years or 5-7 years, the company should repurchase your stock at, I don't know, multiple 2, if ABCD XYZ. Any lockup rights, that's exclusivity while due diligence is being done. So once the venture firm is trying to due deal the business, the project, they sometimes might ask for exclusivity. So no any other venture firm should be provided with the ability or potential, possibility to also look at this business. In current circumstances, with good businesses, it's not the case. There is a huge competition for good projects, but times can change, right? From time to time, there are situations when actually there are not a lot of capital in particular area, so it might be either investor friendly or founder friendly situation. Currently it's more founder friendly situation, but it's the market, things can change. And in particular circumstances, you can ask for exclusivity, and you can, I don't know, use your 60 days, for instance, to look at the projects and be sure that it's only you who is looking at that. And form of the term sheet, but that's more just already technical stuff. Okay. Now let's talk about negotiating and structuring this investment. When we negotiate the deal, let's go a little bit back to the philosophical part. Actually, the deal needs to strike so-called balance between your needs and concerns and the venture capital investment criteria. When I say you as a founder, right? So initial negotiations and different structures for financing will actually generally depend on 3 major things. It's first, that's the concerns of startup founders, also concerns of funding parties, whether it's angel, venture capital, etc., and concerns for both founders and venture firms themselves. Let's look on them. First of all, concerns of founders. What they're afraid of, or what are their concerns? It's loss of management control. Remember, they want to control, but in some circumstances, they might lose control, the founders. Dilution of their personal stock in particular circumstances, right? Or a purchase of their personal stock in event of employment termination, retirement, or resignation, unsaid. Founders concerned about adequate financing. They won't have enough capital to be able um, to try different things with this startup. Security interest, which might be taken in key assets of the company. So let's say your company might lose some particular valuable assets in particular circumstances, and you as a founder, of course, you have a concern about that. You have concern about future capital requirements and dilution of your ownership with this capital requirements. And also other intangible and indirect benefits of venture capital participation. For instance, such as access to key industry contacts, future rounds of capital, and etc. So you as a founder have a set of concerns, and when making a deal, you want to be sure that the deal plays enough on your side. Let's look at the concerns of the funding parties, venture capital in this case. The company current and projected valuation. That's of course a concern for investor, right? Because you don't want to buy high and sell low. You want to make it vice versa, right? To buy low and sell high. That's the level of risk associated with your investment into the business. Actually, the fund's investment objectives and criteria. That's also the area of concern. And to make it clear, it's the area of concern that the project is actually fits your objectives and criteria. The projected levels of return on investment is quite connected with point one here. Actually, the liquidity of your investment, right? The security interest, exit strategy, in event, especially when the business is in failure. So you need some downside protection. In case things go badly, you won't have some downside protection, and we know why, right? Because most of the investments are not returning the cost. Also, you need some upside protection. You want to be able to participate in the future rounds of the company, especially if it meets or exceed the projections. So if the business is becoming hot, it's booming, I don't know, you want to be in this business, you want to put more money, and you want to avoid the situation when you cannot invest, right? And preemptive rights, it's something what is important in the documents. You also want to have some control over management strategy and decision making, so for them not to make bad or obviously awful things. In some situation that might be the case. Remember, it's other people's money, you have to return them, and you don't want management to prevent you from doing so, right? Registration rights in the event of public offering. You want to be sure that your stocks are registered and you can sell. And it's right of first refusal to provide for future financing. Actually, we touch on that. And the concerns which actually important both for founders and venture firm is the retention of key members of the management team and the recruitment of any key missing. Right? Both founders and investors on the same page here, right? They want a good management team to be in place. Any resolution of conflicts among the syndicate of investors, especially when there is a lead investor representing several venture firms, this is something what actually bothers both parties. Financial strength of the company after the investment is also one of the points. I, as a founder, want to be sure that I have enough capital to compete, to fight with competitors in my market and maybe in adjacent market, another geographies. And the same true for venture firms. They want to be sure that they are investing, they are betting on a strong fighter, as they say, right? Here, founders and VC firms on the same page, right? They want the company be a good player. And any tax ramifications of the proposed investments, it's also area of common interest for both founders and venture firms. So any tax things should be taken into account. And both founders and venture firms, they want to avoid any problems with taxes of the business, especially in the current days. Okay, the next we have to move is to the term sheet. Actually, the term sheet is at the start of the deal, and actually it's before the deal is signed. The term sheet is the short summary of agreements among the parties, and it's actually the guidance for lawyers to compose the documents. Right? The documents are very important, but first of all, you have to tell the legal people what to write in those documents. And term sheet, agreed term sheet, is something what is actually used for this. Okay, and the term sheet outlines the proposed terms of investment into the venture company. It defines who gets what in terms of money and who gets to do what legally. What part of legal set of steps should accomplish. And actually, the term sheet usually outlines the outcomes in major scenarios for all the parties. Let's say if the business goes like that or this happens, then ABC. If it's vice versa, then XYZ, and etc. It's important to understand that term sheet itself is not a legally binding document, right? As far as I already told, it serves as a blueprint for formal legal documentation, and which will be drafted by lawyers quite expensively. It will take thousands and hundreds of thousands. If we talk about big businesses, big deals, it might take dozens and even thousands of US dollars. But in early stage, that of course only just thousands, sometimes hundreds of US dollars. So they are simple documents. But still, term sheet is not legally binding. It's just a guidance for the legal documentation. But if you sign the term sheet, whether you founder or VC investor, and you not then stick to that, it will actually destroy at least partially your reputation, right? People will start discussing that you might have problems in the future with the business. Term sheet is mainly about two things. First one is control. Who and how influences the most important company decisions. The second one is economics. Who gets what in the event of an exit or liquidation? Liquidation is another way of exiting the business, right? Not very much successful. Let's go to the control section. The control might be done via the board of directors and via voting rights and investor rights sections. Board of directors, actually, they controls the issuance of stocks. Through the board of directors, you set up a stock option plan for the management team, and you align the interests of the key employees with the business and with investors. The board of directors, they authorize the fundraising, so the next funding round. If the business is trying to get the loan, it should be also authorized by the board of directors. Hiring, firing, or if compensating executive is also a part of board of directors routine. So being a part of the board of directors actually can help to control and actually even perform any those control things, right? So actually you can influence the business if you are in the board of directors. The voting rights, the next section. So remember, some company decisions depend on shareholder vote rather than a board vote or in addition to. So it all depends on the charter of the business, right? Different businesses are structured differently, and in a nutshell, some voting rights of the shareholders might play a role here, and this is a part of the control aspect of the deal, right? For such decisions, the voting power actually comes down to stock ownership and the voting rights associated with various classes of stocks. They might be founder friendly or VC friendly majority. So this is the part of the legal work where you have to be sure that having particular stocks provide you with, I don't know, particular rights, and you need to make your homework and understand um, the relative power of voting rights among the different share classes and shareholders. There might be, remember, dual class voting. For instance, there might be two classes of A and B shares, but the votes might be split disproportionately. So while the economics might be split proportionately, the voting rights might be split proportionally. And that is still, as far as I know, quite common for United States, right? Remember that even with Tinkoff in Russia and with Google, the different aspects, different types of classes of shares, even in the public market. Then next, tenured voting allocated voting power based on the length of the time of the shareholder has owned his stock, right? So voting rights. There might be a situation then when the voting rights actually depends on the time you're in the business or the time you're a shareholder in the business. Actually, I personally haven't met this, but they say this might be the situation in some cases. For you just to know, investor rights, so protective provisions on key actions. Investors want to control how the company will be dissolved. Investors want to control if in the situation when there will be a change in certificate of incorporation, so any bylaws of the company. So actually the basic documents which actually frames the business, the framework for the business. Authorization or issuance of new preferred stocks is also something that investors will want to at least have some control on. Same for purchasing or redeeming other stocks or taking debt sometimes, right? If you're an investor, you are a stock investor, right? Equity investor, and you don't want the business be overloaded with debt and the economics actually go up into the capital stack. Entering into strategic partnership is also one of the aspects you want to control. And the changing the size of the board of directors is also part of your area of interest as an investor. Now let's talk about the economics. Economics in the term sheet actually presents several important aspects, and first of them again is valuation. The term sheet will state that the pre-money valuation is X. If we invest I, then the post-money will be X plus Y. In simple situation, right? It's not always the case. If convertible notes are being converted into the stocks in this particular round, things are becoming very much more complicated. I will try to show you. And valuation actually, it determines the percent share of the company equity which is being sold in this round. Option pool to align the interest of management, key employees, and the business. It will be based on whether pre-money or post-money valuation. It will have some strike prices for the stocks. For the stock price, yes, as far as I remember, every option should have a strike price. Vesting, remember, vesting means that you are getting your exposure as a key employee into your stock options and equities with time, right? And usually there are so-called cliff vesting after 1 year. So you have nothing during year one, then you have a proportionate share after the end of year one, and then every month you start getting additional stocks options. And the option pool might expire. Let's say 90 days after you have left the company, your option is no longer valuable or provides you any right to buy the company stock. Now, another part of the economics, it's liquidation preferences. Downside protection, which help you actually to get your money back from the business. in bad situations. The standard currently is 1x. So I invested $100. I want to be able to get this $100 back. In bad situations, especially after the dot-com bubble in early 2000, the liquidation preference could be 2 or even 3x, which meant that should I invest at 1,000, I want to get at least 2 or 3,000 back. It was very investor friendly and very founder unfriendly. So actually, founders were trying to make businesses while assuring investors that they will get huge returns. So that was the situation. When there were a lot of projects. There were a few. There was like the deficit of capital. Investors didn't want to put money into the venture business, and that was a good time for venture funds who understand the businesses at those times. And liquidation preference actually again provides priority upon liquidation before earlier shareholders. So if you have a liquidation preference in front of me, so you will get money first. Only then, if there is still money left, I will get some money back. It's like with venture or private equity funds. Remember the waterfall, how it works. First of all, the cost back to limited partners, then some preferred return, and only then general partners start receiving any carried interest. So here is standard. So let's say there is no hurdle, but there is so-called cost first to limited partners, right? So here it's something similar. First cost goes to investor, and then all the other investors can get something. And it's participation rights, a quite important area of economics. It actually allows to get invested money back, and then in addition to that, participate in the upside. So this is the investment friendly situation. So sometimes might be a situation that first I get my cost and I still have my percentage in the capital stack, and in the remaining capital stack I take my percentage. Let's say I invested 1,000 and we are getting out and I have participation stock. First I will get my cost, and in addition to that I will get the percentage share of remaining capital. It's very investor friendly, not something very common today, but again, that was more common in difficult times for venture industry. And this particular thing, which participation can both have cap, which is the upper limit, or it can be without cap. In the latter case, it's punishing founders because the investor actually is participating indefinitely in the upside, right? So not only he gets his cost back, but also he has this actually option without any cap on top. For you just to be familiar with that. This is interesting statistics from PitchBook. It's almost 3 years outdated, but so you can imagine that it's even lower today. But deals with participation rights, they were steadily declining through years, right? Starting from the financial crisis. But as far as you see, even after the financial crisis, which was in the real estate sector, right? Yes, it was global, it was financial, but generally the problem was in the real estate and the banking system. More than half of the deals had participation rights at those times. So it was quite investor friendly situation. But with time, it was becoming more and more founder friendly, right? Currently, I don't know the particular number, but I'm sure it's even lower. It's maybe somewhere 10, 15, maybe even less. Interesting point, dividends, right? Not something that startups are usually providing the investors with, but dividends might be not in the form of cash, but in the form of accruals or paid in kind things. So the dividends here actually are percentage returns which accrues to preferred stockholders. You have a preferred stock and it has an accrual dividend on that. The dividends might be cumulative or not, so they might actually accumulate with time or just being paid once and that's it. They might be also paid in kind, which means in the form of additional shares. Dividends are not very often currently, but still, for you just to get the idea, there might be some dividend component into in the structure of the shares, and in other words, it is something like interest on your investment, right? Next section is anti-dilution. Anti-dilution protection protects investors from gross dilution in later down rounds. In case the company is in a bad situation, we have new investors who are trying to buy out the business cheaply, or they participate cheaply. The previous investors are somehow protected with anti-dilution. It's not the case in the most risky scenarios. So if the business is about to go bankrupt, like with travel companies a year ago, then all those anti-dilution protections that just doesn't work, because the best next option is new investors are not coming in, then the business goes bankrupt. But somewhere in between, anti-dilution protection helps current investors and not being diluted very much, right? The dilution effect is much lower. And the anti-dilution might be in three versions. It might be first full ratchet, it might be narrow-based weighted average, and it might be broad-based weighted average method. Just for you to get the flavor idea, the full ratchet is the most friendly for previous investors and the least friendly for founders. So all the dilution which happened goes from founder pocket, which is not good, which is not a good situation, right? Because you actually decrease very much the alignment of founder with the business and investors. And the broad-based weighted average is the most founder-friendly situation. We will try to look at that today. With regard to dividends, cumulative dividends provisions, as far as you see, also were decreasing very much. It was only 10% even at the time of financial crisis. So I told you it's not very often. But still, it was the case. Still, it was the case recently. But so in aggregate, be aware that maybe in one of every 20 deals, there might be a cumulative dividend provision. It's very good for not founders, I'm sorry, investors, but not very good for founders. And so just don't forget, read the documents. There are a lot of interesting things in this space, and they might just be aware of different of them. And as far as you understand, for you as an investor and for you as a founder, there are different instruments to negotiate the deal, right? The more instruments you have, the more chances that you finally will agree on the deal in aggregate, right? For instance, you will go to compromise in terms of cumulative dividends or liquidation preferences, but you will get your more important things on the other side of the table, and the deal might be done. Oh, I'm sorry, for a second I have to close the window because I have a huge rain outside. I'll be in a second. Sorry. I'm sorry, I'm back here. I'll try to turn on the video. No, it doesn't work. Yeah, I was talking that there are different aspects on the deal, and if you want, you will agree on the different aspects. So you will give away somewhere, you will take yours on the other side of the table. And now let's go to the major types of securities which used in the deal. And first of them is, of course, the most simple one. It's common stock. It's rarely chosen, especially in early stage investments, by investors and founders. And I will tell you why. It actually offers investor no special rights, on no preferences, no fixed return, no ability to exercise any control of the management, no liquidity to protect you from the downside. So there is nothing special in this type of security for you as an investor to protect your capital. So usually common stock is the stocks which founders have. And that's usually the stocks on which the option pool is targeted for businesses. Uh, Common stock can lead to negative tax consequences for employees if they're used by venture capital investors. They might create so-called phantom income if subsequently issued to employees at a cost lower or much lower than the price per share by the venture capital, right? So if common stocks are provided, then they are repriced. It might be the tax problem. So usually, again, they use for founders and employees, and just for you to get another flavor of why not in terms of common stock, let's theoretically have a situation. You just have founded the company, you have 100% in that. And I'm an investor. I'm taking 20% in the business and I providing you with money. Let's say you put zero capital. So it's just a company, it's just the idea. It's in the form of a legal company with 100% ownership by you. I'm taking 20%, I'm putting money, let's say $1 million into the business. And if it's a common stock, what you as a founder having the control of on every aspect of the business do, you just stop the business and liquidate that. And you get you get 800,000 and I get back only 200,000. So my investment is only 20%, but you have just made 800,000 case, right? Because the stocks are equal. So I, as an investor, I need stocks which will prevent this bad behavior potential, right? So it should be something else. It should be something on top of the common stock. And this is the preferred stock. But before that, let's look at the actually the structure of the common shares, how they work. It's linear, right? There is unlimited upside, downside can go to zero. So there is a linear um, relationship between the value of the share and the value of the company. In terms of the preferred stock, it's not the case. But first of all, preferred stock is a much better option for investors. Preferred stock has certain rights and privileges which common stock doesn't have. It's senior to common stock. So preferred stockholders get their money first in the event of exit or liquidation. Coming back to my example, if you founded the company, I'm getting 20% and I'm putting 1 million in that, and you stop the business and I have a preferred stock, first of all, I get my money back. So actually you will get nothing, right? I will take my million back. I will redeem the preferred stocks and etc. So this behavior will be avoided. But interestingly enough, that when raising round of preferred stock, Article of Incorporation will be amended to lay out the terms and definitions of those newly issued securities. So every time new securities are being issued, actually Article of Incorporation should be amended, should be changed. Let's mention several important things which preferred stock has. First of all, it might be converted into common stock at when you as a holder of that bond, or when exit, let's say when the IPO is being done, all the preferences are liquidated, all the preferred stock becoming common stocks. The preferred stock might have some dividend, usually accrued, right, which we mentioned before. Not often, but still it's possible. This instrument allows you to incorporate that mechanics and financial mechanics into the share. The preferred stock provides you with liquidation preference. Standard is 1x, but it might be different, might be bigger. The preferred stock, interesting enough, can provide you in addition with some participation rights. Remember, participation rights is when you, in addition to getting your money back, can participate proportionately in the remaining part of the capital stock. Can have dividends, different, strange. I was tired. It's the same. Anti-dilution protection is also something it might have. Some redemption schedule, very rare, but still mechanically. That's the instrument which allows for a lot of adjustments and things. And it also can have special voting rights and preferences. So of course, such type of instrument is much better for investors, right? Rather than common stock. And this is the preferred shares, how it works in case it's just simple preferred shares. Nobody uses simple preferred shares, but for you just to get the idea how it works. The value of share is not linearly dependent on the value of enterprise. So this angle beta is higher than this angle A. So it means that actually the value of the company and value of shares are not linear. I forgot this word. Dependent. I'm sorry. This is how it looks. And if you participate, so once it's convertible, participate in pre-work, so shares actually what you have this, remember, simple line with angle A, and you have this line with angle B. So convertible participate in preferred shares, what it says, it gives you some protection when the value of the enterprise is low. You see, there is some conversion or break-even point. And if the value of the enterprise goes down, in terms the preferred share is still keeping its value for some time, right? And actually, what it does, it just dilutes the value of common shareholders. And then there is some point in time when it goes down with angle B. It's when actually founders are already diluted and you just start losing your money. And then you still can participate in the upside if the situation is better. So it's senior in terms of capital structure, and you still have upside potential. It's more investor friendly, of course, not founder friendly. Convertible debenture or convertible note, we will touch that. It's a debt instrument. It might be secured or not. It's used in high risk transactions. Investors usually treat it as creditors until risks are mitigated. The bridge financing might be provided in terms of convertible debenture. There might be a conversion into equity upon specific terms, conditions. Before conversion happens, convertible debenture actually provides investor with a fixed rate of return and offers tax advantage to the company. But convertible debenture is one of the securities which might be used in the deal, but to be honest, in venture is not very common. Convertible note is much more common thing. It's usually used in early stage investments when valuation is too difficult to agree on. Let's say we like each other as a founder, as investor. We see the same how the business will be developing. No problems, but you want much higher valuation than I think is justified. And what we do, we structure the deal in the form of convertible note. And actually what it says, it issued to investors in exchange for stock at a later time. So actually we put the valuation aspect aside and we say, okay, in the next round, when the third party will come and validate the business and agree on valuation with founders, that will be the valuation, which will be used today, but with some discount, right? Because we're bearing some risks. And what happens, actually dilution upon the conversion when it happens, but it might be quite tricky. I will show you today, but the idea is following. I'm putting the money, I'm getting the convertible note, and I convert this note into the stocks later on at particular valuation. So at particular price, which depends on the valuation in the future. The major benefit of this convertible debt round or is speed. Actually, structure on this deal is easier and it's becoming faster. In early stage investments, there are widely used instruments by startups, which actually KISS or keep it simple security, or SAFE, which is simple agreement for future equity. So they have the same idea. They have pros and cons in terms of for investors. But the idea is simple. We make the deal fast, we make the deal simple, we make the deal cheap, and we're in the business, and the thing about the valuation is in the future. So we hope that there will be other rounds, there will be validation, and with time, valuation becomes closer to justified, right? And just we will use it and apply some discount. And this is how it works. There is a so-called interest rate, so it accrues like X%, but it's of course usually not paid. It increases the final amount that will be converted into equity in the later round. So I provide you $1,000. Let's say we have 5% per annum. In 1 year, when we will be making this conversion, we will assume that I have invested not 1,000, but already 1,050. And 1,050 will be converted at particular price, which we will calculate somehow. There is so-called conversion discount. This is the discount rate which applies to the company valuation for the purpose of calculating this conversion price. Let's say if the company valuation is $2 million US and there is a 20% discount, then the note will convert at the lower valuation, right? It will be 1.6. So actually, when converting one type of instrument into another, we will be using this lower valuation to convert. Why we need that? Because it actually reflects the risks which earlier investors who invested through convertible notes bear before this particular round. There is also a valuation cap. It's actually in essentially unbounded conversion discount. Let's say a valuation cap of 10 million allow the investor to convert into equity at this 10 million, even if the actual valuation will be 100 million. So it's a tricky instrument. It's quite interesting. It can provide you some very interesting payoff profiles. Let's move on and touch upon the debt instruments with warrants. It's often preferred for some reasons as convertible debt. It can protect you on the downside. It can protect on the upside when you have actually warrants to purchase common stock at favorable prices and terms. Actually, warrants enables the investors to buy common stock without sacrificing the preferred position as a creditor. And the case with convertible debt is quite similar to that. So in a nutshell, what you have to get from here is that there is common stock, very simple, but not used by venture investors. That's the stocks needed, actually, stocks of founders and the team. There is preferred stock, which might have a lot of aspects, and it is mostly used by venture firms. But in case that we have not agreed on valuation, or in case this investment stage of the business is very early, we most probably will use a convertible note, which have some particular interest accrual, conversion discount, and might have a valuation cap. Today we will touch deeper on this and particular other aspects, but we will stop here for a break. And now then touch basic startup valuation. Again, actually, we will remind ourselves what we did next time, and we will continue. Today we have to look how some particular things work in deals. Okay, again, I'm asking of things. You have all voted. Okay, I close the poll. Thanks for this. And let's have a break of 10 minutes and see you in 10 minutes. Take a break and take some coffee, and actually prepare questions if you have them, and don't hesitate to voice them. But I know it's much convenient for you to chat, so drop it in the chat if you have. Okay, see you soon. Sorry, my video today is not working. We'll see each other. We'll hear each other in 10 minutes. Okay, let's continue. I hope you have a chance to make a break. The basic startup valuation. How much are you worth? Let's first of all discuss what is valuation about and what are the determinants of value. Remember, it's cash, of course, and it's time. It's risk or perception of risk by investor. The greater the risk, the greater the reward, at least the expected. There are important psychological factors in valuation, and remember that capital market valuations and liquidity influence a lot the valuations in the venture space. The average price to earnings ratio was about 8 in 1987, when there was a crisis, right? Versus it was 30 in 2001. And in 2021, the PE is roughly 30 again. And they have a lot of liquidity currently, which means that most of valuations of startups have increased. And actually, I showed you last time some statistics in terms of graphs, um, in particular, the valuations by rounds throughout the year. And we saw that there was a sufficient uptick in valuations. Um, so greed and fear of missing their running up value, they might influence the valuation. Usually in these cases, the valuations are high. And remember that value is in the eye of the beholder, right? And we are different. We have different psychological factors. We have different perception of risk, um, time, and the value of cash in our eyes. Also, type of venture capital investor and his or her required IRR, as well as expected holding period, might influence the valuation aspect, right? For different investors with different required periods and IRRs, the valuation might be different. If you require less IRR, for sure you are more comfortable with making a deal at higher valuation, given the exit assumptions are the same. Other factors which might impact the valuation, that's the management experience. The more experienced the team, the higher value you would assign to the business, all equals. The size of the opportunity or the addressable market. Remember we touched that already last time, but the bigger the market, the addressable market, right, which you can actually can have access to potentially, the bigger the potential. The bigger the potential, the higher the valuation should be. The size of the round also is part of this valuation equation. So the more money goes into the business, um, actually it influences the valuation, the post money for sure, right? Any intellectual property or other barriers to entry, right? It's about market due diligence already, but still, it all connected. Any need for future rounds will influence the valuation because the bigger the cash drag, or in simple words, if you expect one or even more future rounds, for sure, so business is good, but it's very much cash negative, it will require additional rounds. You will have some discount here potentially, all else equal, right? If it's the last round, you see that the business is growing, the product is already validated, the acceptance is high, traction is high, unit economics is good, and there is a potential to go, I don't know, other geographies, so just expand. And even in these circumstances, no more money is needed, so the business model is relatively good. Most probably the valuation will be high. You as investor have few risks here, and it's a quite good business in general, quite good, I'm sorry, business idea in general. You will most probably invest in that even at high valuation if you can go out in 1 or 2 years or in IPO and get your 2x or even more. Industry comparables are of course important. If the business is unique, valuation might be a challenge. But if the business is not unique, if you have already players into the market, of course, you will have to compare against them as well, and it will influence the valuation. Exit opportunities. You might have several. The more you have, the better for you, the more options you have to exit. So if IPO is an option, which means the business is relatively big, usually it provides additional upside to the valuation. If IPO is not an option, so the possible exit is only sale to strategic or financial investor, it might influence the valuation negatively. Not badly, but just all else equal, have an IPO as an option or SPAC. SPAC exit for SPAC, it became quite popular last year. Is really, really a good upside to valuation. Actually, SPAC is much faster. It's not always good for investors into the SPAC, but to exit from the business as a venture is a really good option. And when we talk about valuation in public markets, it's quite clear what we're talking about, right? We're talking about a particular value of stock you can buy or sell throughout the day. When we talk about valuation in venture, it's actually just a price tag for future negotiations, especially in early rounds. What I mean is just a number. It's just the result of how we negotiate, we as founders and investors. It doesn't mean you can sell this at this price or you can buy more at this price. It's becoming more close to public markets with late stage investments, be it unicorns. So there are actually what banks are doing currently. They have the platforms, they are making the platforms where these non-public, highly sought companies, unicorns mostly, are being quoted. So let's say there might be a quote for a particular company, and you can buy or sell every quarter some particular stock in the company. I don't know. If we go back several years from now, I would say you that Uber and Lyft or other companies not still being public were already possible to be bought or sold in this platforms. That was not the case those years, but currently it's becoming more and more the case, which is good actually, right? It provides additional avenue for liquidity for VC investors. So the market is maturing. So it's liquidity is becoming more liquid, a little bit more liquid. But it's mostly for late stage successful businesses, highly sought, especially currently when there is a lot of capital in financial markets. But it's still not the case for early stage businesses, right? In early stage businesses, it's just the number. It's critical component often to whether the deal will occur or will not occur. If convertible note is not an option, because you can avoid this conflict on valuation with convertible note, then valuation might be a deal breaker. And again, valuation assigned to enterprise as a result of financing event. Remember, we have pre-money, we invest I, and we have post-money. So actually, we have agreed on something, we get money into the business, and we have these two numbers. Pre-money and post-money valuation are two fundamental concepts, again, in this evaluation. I will repeat that, but from last time, but pre-money valuation is the value of the business right before it receives the funds, and the post-money incorporates this amount. It's just right after, right? As I already told, it might be a deal breaker, especially for when the founders have big or great ego. Pre-money valuation and the level of venture capital investors is subject to intense negotiations between the parties. And also parties bear in mind this fundamental issue of dilution. And as far as we understand, both this party will be diluted with next rounds, founders and current venture investors. At the early stage, valuation doesn't show the true value of the business. Again, it's just a number. It shows how much of the company investor gets for his investment. So look at this differently. You invest $1 into the business, what percentage of the business you get for your dollar? So look at this differently a little bit. I will remind you the post and pre-money valuation concept. So post-money valuation equals pre-money valuation plus the investment amount in this round. And if we want to get the proportionate ownership of VC investors in this round, we have to divide I by post-money valuation. right? To get the price of share in particular round, we should divide pre-money valuation by the number of shares outstanding before the round. So actually, you can get the same number with post money and shares outstanding after the round, but you have to know the additional number of shares issued. But still, it's just numbers, right? Simple calculations. You easily can do it in Excel, and I highly recommend you to do that on your own with simple examples. And let's look again at one of them. Not all of you were last time. So we invest in 1 million into the business, and we agree that the value of the business without this money is 3 million. And the number of shares before this round was 1 million. Let's get the post-money valuation, the share of the company the venture for investors get, and the price per share. The pre-money valuation plus investment will give you post-money valuation. It will be 4 million. So if we invested 1 million into the business, which currently valued together with cash as 4, we get 25% in that. The share price will be $3 because we have to divide pre-money valuation by the pre-round number of shares. Right? So actually you will get the same number if you will divide the 4 money by the number of total shares after the round, but it will increase, right? It will be 333 as far as I get 333. Now let's wait a second. Just want to know from you that this one is clear. If not, please write in the chat. We will come back to that. Now let's go to legal docs and slightly discuss this topic. Legal documents in the deal, they contain all the legal rights and obligations of all the parties negotiated between, right? So what types of legal docs will be touched when the deal is being signed? It's stock purchase agreement. I usually prefer stock purchase agreement as SPA. If you will find this abbreviation, SPA, usually it means stock purchase agreement. Or it might be also called investment agreement. It contains all material terms and conditions of financing, right? Stockholders agreement. You might come across the abbreviation SHA. SHA. It's shareholder agreement. This one contains certain restrictions on founders' actions, and it provides additional rights to particular investors, usually to new one, right? So actually, it says what rights and obligation each shareholder has in what circumstances. There might be also an employment and confidentiality agreement, usually defines each key employee's obligations, his compensation package, and actually the reasons for his termination. There might be some warrant agreements where applicable, etc. So a lot of other documents, but remember, there are major of them. So if you buy stock, you have a stock purchase agreement, and you become a shareholder, there should be a shareholder agreement. If it's debenture or not, well, applicable, it's also will be agreement on that. They should be so-called preferred stock resolution. It's to issue new preferred stocks. You have to, the company, it's the corporate act, type of corporate actions, right? They should be a preferred stock resolution. So legally, they should be a document saying that this is happening and new types of shares is appearing, and etc., etc. If needed, amendments to corporate charter should be done as well. And they set forth the special rights and preferences that will be granted to investors in these new types of securities. They might be contingent proxy, which provides for a transfer of VC voting rights of key principal upon his death. So it's a bad situation, but it's life, right? People can die. And if the risk materializes, there should be some mechanism of using votes of those shares of the founders. The legal opinion of company counsel also might be important. And remember, registration rights agreement allows venture investor to register his rights and exit upon IPO of the company at the expense of the company. Yes, that was something I was not mentioning at the start. So registration is happening at the expense of the legal entity which wants to register the shares. And you, as an owner of the shares, you won't just the company to register your shares as well before making an IPO, which for you will be an exit path, right? Not exactly at the moment of IPO, usually in 6 months after, so-called lockup period. Okay, this I will show you several diagrams now, which are not mine. I took it from Seraph. It's one of the source on angel investors, a really good one. But I found them quite interesting and easy to comprehend. So if we to sum up what investor actually wants, the investor actually wants management and control, right? Investors are very cognizant of exits and liquidity. Two things are very much connected. They want to make sure they can get their money back in all different possible scenarios, right? In all different scenarios. In the first section, as far as I already mentioned, we want to control bad founders' behavior. So what actually it means in a nutshell, we don't want the destruction of value. So we want to have instruments and oversight control instruments to avoid destruction of value. And we want to understand what is going on in the company. It's even more important because in public company, you usually have lots of documents being issued on a regular basis. There are some regulatory obligations. But with private companies, there are not so much obligations. And for you to get the information from the company to understand how your money is working there is difficult. So still, you want some instrument for that. Of course, you want to be protected, right? You want to be sure that nobody diminish your value or distract that, or gets liquidity ahead of you, right? Or dilute you in the next round. And of course, deal economics is again one of the aspects. You want to be sure, or at least you want to think you are sure that you have enough slice of the pie, right? You want to be sure that you get paid back first or among the first. Or you want to put so-called a time clock on founders, which actually will force them to put more efforts into the business and be more aligned with you, and etc. If we try to dig deeper in each of those sections, actually the management control is being realized through board seats, through so-called information rights, according to which the company is obligated to provide you particular information with particular schedule. You want to have so-called founder vesting when the founder is becoming more exposed to the business through the common stock holding, but only with time. You want to be sure that the founder will not leave the company and compete with you right immediately. So you will have some non-compete things. Exit and liquidity aspect is being translated through different types of things, and the right to block transfers by founders. Again, founders should not be able, because they have a large stake into the company, especially in early stage businesses. You want to avoid the situation when they just transfer it to somebody else you don't know. Because when you were invested into the business, you were looking at the management team, right? Remember, people are very much important in venture. And when you were agreeing on providing capital, you took into account both business side of the equation and people side of the equation. And founders are leaving, they transferring their shares. For you, actually, it's the game changer, right? And the drag along rights, tag along rights, that's the things I hope you're aware about, but just for you to understand that you want to be able to either force other shareholders to sell together with you, or you want to be able to jump onto the sale deal of other shareholders. So the idea is just to be able to get out if somebody is getting out, or to force others to exit when you want to exit. It depends on the size of your stake to the company, but just for you to understand the idea. Redemption rights, not often, but still situations when your stocks will be redeemed by the business, usually. Registration rights, we have covered it already. But again, you just want to be sure that the company registers your stocks for them to be a part of the IPO and for you to be able to sell them later on. Protection is being being done through anti-dilution protections, some list of approval rights, participation rights. There is so-called right of first refusal and co-sale rights. Co-sale right is actually connected with tag-along drag-along rights, but it's more or less about the same. Again, I will repeat that legal part is very important. In this business, it's quite important. It's not only about models and analyzing markets. You have to be friends with lawyers in this business. You have to greatly understand how it works. Um, the deal economics is covered by the size holder round, the valuation itself, of course, the liquidation preference, which provides you some downside protection, some dividends, which in other terms usually is the clock on the founders, time clock on the founders, and option pool, because option pool for sure will dilute you. It is important how exactly and when exactly it will dilute the investors. These are the documents which actually shows you in what documents, what types of the aspects of the deal will be covered. So the stock purchase agreement will cover the size of the round, the valuation, the option pool, investment rights agreements. Yeah, it's actually IRA. Sometimes you can find it's IRA, IRA. It will cover registration rights, information rights, pro rata participation. It will cover maybe some board seats and control, and these particular aspects and some even others. Right of first refusal co-sale agreement will cover only this one. The voting agreement will cover the drag-along rights. Also will cover again the board seats and control, rights to block founder transfers. Certificate of incorporation will cover anti-dilution protection. So actually how the economics is being split among the different types of shares, because you will be a shareholder of particular share class usually, right? Preferred stocks in different rounds, different types of stocks have been issued. So it's Series A, Series B, C, etc. If dividends are possible, accrual dividends usually it will be covered in the certificate of incorporation. And founder stock agreement will cover the founder investing and the non-compete clauses. So the source of this is the Seraph Compass. It's seraph/investor.com. It's a nice source on early stage venture investors. It's actually about mostly angel investor investing. They recently have acquired. They recently got nomination in the state. So actually a good source for you to get you familiar with different aspects of early stage investment. And the path from start to exit might look like this one. So there is time. With time, they might be fast fail, or they might be early exit. They might be fail after multiple angel rounds, even VC rounds, as far as you see on the other side. Or the company might become so-called zombie. It will be cash flow positive, more or less, but the growth will be relatively small. It's not something very of interest for VC investors, as far as you know, right? You want to be on the S curve. The business should grow, not exponentially, but double digits for sure, and several X during several years. On the upside of this, they might be royalty or buyback. They might be a quite large acquisition, or if company is successful in terms of growing to the big enough size, it might have a successful IPO. Okay, that was it. And now we go to the topic of anti-dilution. And anti-dilution, this is the protection in down rounds when new shares are issued at lower price. What anti-dilution does, it actually lowers the price at which old share converts to a common, rather than issue more shares. So usually, initially, when you are an investor in the business, in the venture business, you have remember preferred stocks, right? And these preferred stocks are usually convertible, which means that they might convert into regular common stocks to get the upside. First, at the willingness of the venture investor, who is the holder of his preferred stocks, or at the time of IPO. At the time of IPO, all the preferred stocks all are converted into the common stock. So, and usually the conversion is 1-to-1, but the things become more complicated and trickier if there is an anti-dilution protection, which worked actually. So this conversion price changes. So instead of getting one common share instead of one preferred share, you might end having, I don't know, 1.1 common shares instead of one preferred share. So effectively, on a fully diluted converted basis, when you try to look at the capital structure of the business, you will get slightly more, right? Common shares, I'm sorry. Given that there will be other shares from new investors buying at a lower price, you will have dilution, but the effect will be lower, right? Because effectively you get more common shares for each preferred share. Flavors of this anti-dilution are different. So the full ratchet situation, the full ratchet anti-dilution, it means if even a single share issued at a lower price was in the next round, even if the small round, even if one share was issued at lower price, all shares will convert at that price. So actually, effectively, even one shares, which is become, I don't know, 3 times cheaper than the previous round, you will get 3 times more common shares, instead of preferred shares. It's very founder unfriendly. So even a small round with down valuation actually dilutes hugely, and it fully protects the investor. Nice for investor from one side, right? But of course, I can't imagine the situation the founder will be so much dedicated to the business after such a case. So more often is weighted average. It's actually when the old price adjusts only partially to new price. And it depends even more on the relative amount of capital raised in each round. So it sounds more fair, right? The more capital the company is attracting on the down round, now the more effect should be on this adjustment, right? So if it was a small round, only the previous investors should not be affected that much. Weighted average dilution might be so-called broad-based or narrow-based. Broad-based means that all stocks should be taken into account, but not convertible notes. Convertible notes are not taken. Narrow-based, it takes into account only preferred stocks when making calculations. So again, in the broad-based, common stocks are also taken into account, so founder stocks, etc. In narrow-based, only preferred stockholders, so usually venture investors, and their stocks are taken into account. Now let's look at the examples. Full ratchet. So in this situation, new adjusted conversion price equals new share price in down round. So let's say we had 1,000 shares initially worth each $10 each, and it would convert it into 1,000 shares of common with full ratchet anti-dilution protection down round. If the latest price was twice lower, so it was $5 instead of 10, it means that our 1,000 preferred shares actually converts now not into 1,000 common shares, but in 2,000 common shares. Right? Effectively, we are getting twice more shares at twice lower price, and keep our exposure to the company. Not very founder friendly. Weighted average is slightly more complicated formula-wise, but actually not so complicated. The new conversion price, which actually converts your preferred stock into the common stock, so it's just a ratio. Keep it as a ratio which you will use when you decide to convert, or you will be forced to convert. You take the old price, which in this case is 10, and you take the number of old shares into the numerator, and you would add here so-called would-be new shares, and you should divide it by the number of old shares plus new shares. And would-be new shares here actually means if I take the size of the round and divide it by the old price of the share, so the one which was higher, right? So effectively, the would-be new shares will be the number of shares which will be smaller than the number of new shares. And let's look at an example here, how the effect will be. It will be the effect. So let's say we have a Series A, 25 million US dollars post-money valuation. After investing seven with something million US dollars at $3.03 per share. And let's say in the next round, we have a lower valuation, the pre-money valuation. Why we compare the post-money on A and pre-money on B? Because this is what you can compare, right? You cannot compare pre-money with pre-money in different rounds. You have to take the pre-money current round, I'm sorry, and the post-money in previous round. That will show you whether the valuation of the company actually decreased or increased the business, because it included cash before. Currently, it's just a business which might have some cash, but it's before the new cash is in the business. So, in a nutshell, when we have no options or shares granted in the interim and the investment is, let's say, 10 million US dollars, so actually the 15 million pre plus 10 millions in, it will be again 25 post money, right? In this case. And let's say we have 5% unallocated option pool included into the pre-money valuation. So what we will see here is the different effect of different types of anti-dilution protection. In the full ratchet case, which is to the right, you see that the common shareholders actually will have the lowest part of the lowest share in their business. As far as you see, the Series B investors, which are the last investors, will always have the same share of business here. It will be 40%, right? How you get that? You divide 10 million by the 25, where 25 is 15 million Series B pre-money plus 10 million investment. So post-money means pre-money plus investment. It's 25 on the last round, and we invest in 10 million, so it's 40%. So Series B investors will have the same share. Right? And the case here is actually what Series A investors on a conversion basis to common shareholders will have. And in case of full ratchet, they will get the highest share into the company at the expense of the founders. In no anti-dilution protection at all is the most to the left, right? They will have much less share. So actually they will bear the costs of this dilution together with founders, but still proportionately wise, they will get lower. The broad-based weighted average will be somewhere in between. So partially Series A investors and partially common shareholders will bear the cost of that dilution. So in a nutshell, dilution is not something that will be avoided, but the split of that effect among the previous shareholders, which includes actually all shareholders, from common shareholders and founders to all the previous Series A investors, it's actually something that should be managed and calculated here, right? So the anti-dilution protection will be responsible for that split of effect. At the bottom, you see the link, and I highly recommend it just to read it. It's the CooleyGo.com. It's one of the legal firms specialized in venture investments, and they have lots of interesting short papers. This is the one from there. You will not get it somewhere else. But I think it's a really good illustration, and to get more understanding, just I highly recommend you to go there and just read. They have lots of things on venture investments in quite simple form. Just highly recommend. Just a part of additional source for you. Look, if we change the amount of money, you see, I'm just changing it. We will see the different effect. So as far as you understand, the venture Series B investors will get only 16.7 instead of 40 here, right? And we will see again this effect of dilution, which more or less is the same. It will be equally split again, somewhere in broad-based average, without any anti-dilution protection. Most effect of dilution will be borne by Series A investor, and in full ratchet, actually Series A investors will keep more or less, they will keep their share at the expense of the founders. It's just what I decided to show you. As far as I remember, we have both of these examples. Okay, guys, if you have questions with that, please let me know. But just to sum up, anti-dilution is covered in this presentation. I provided you the link below to read it in details. And anti-dilution is provided into the book, which is must read for that, is the Finance of Innovation, which I provided you. So then majorly you have to cover only 4 blocks, on the even 4 chapters. It's 7, 8, 9, and 10. Just read it one after another. It will provide you enough understanding of our course. The book is really good, but it's quite complicated. And 7, 8, 10, and 9. Sorry, 7, 8, 9, 10. It's the chapters you should read. And actually, next time we will have a test. Now let's go to the convertible note, and we'll cover how it works. First of all, it's a debt instrument, right? They must convert into equity at a later date at some conversion price. This conversion price is subject to conversion price discount and conversion price cap. So actually there are several parameters which should be used when making calculations. The conversion price cap is the maximum valuation at which the convertible debt or other standard agreements convert at the time of financing. So regardless of the valuation agreed by the company and new investors in later rounds, this cap might play a role. So there might be a situation when you have a cap in convertible note or you don't have a cap. I will show you in details today. First of all, there is a principal amount of the note, right? So this principal amount of the note actually automatically converts in connection with this next financing. Interestingly enough, that in convertible note agreement, there might be so-called minimum size of financing to trigger this automatic conversion. As an example, we have a convertible note. We invested $1 million into the business, and it says that if the company attracts in the next 12 or 24 months the financing which is lower than 1 million, then the convertible note holder decides whether to convert or not. He has this option. But if the business attracts more than 1 million US dollars, then the conversion is automatic. So you as a convertible note holder will be forced to convert from note, so the capital structure, which is effectively debt, into the shares. There might be some other additional customary terms. They include this optional conversion, etc. But always read the book, always read the papers. There might be some premiums, etc. But it's not something of interest for us. But keep in mind that there might be some other aspects, sometimes important. And the principal amount is the face amount. It's what we invest as an investor. Remember, if it's a note, there should be an interest usually. Currently, the interests are low. It might be 2%, 3%, rarely 5%. They used to be higher, but still, it's something. Interest rate is usually the annual rate at which this interest is accrues. Actually, it does accrue, as long as the note is being outstanding. So before the conversion of the note into shares happens, there is an interest which is being accrued. Just look at this as the deposit or fixed income bond with a particular price, which is face value. This principle, this interest might be either compounding or simple. I'm sure you are familiar, but just it either compounds, so you just mathematically or geometrically add that to the principal amount. It might be repaid in connection with conversion, or it might be converted into additional shares at the same terms as the principal. Yes, as I told, it used to be close to high single digits, but now it's very, I would say, symbolical. There might be some additional discount in connection with conversion. Another important aspect of the convertible note, it's the maturity date. It's when actually this note becomes due, right? When the company should repay the debt. Usually, notes have flexible repayment language. It will require holders of the majority of outstanding principal of amounts to request this repayment, and etc., etc. So I try to make it harder for you just to get the flavor of how it will be more or less written into the papers. Right, but okay, it might be flexible, and holders might decide to elect to receive the stocks. So usually convertible note is held by many investors. It's not the case that you are the one. So if it's several investors, they have to somehow agree what to do with this note, whether to convert or not to convert. And the maturity date is also set the expectations for investors. The likely outside date for closing an equity round. So usually you will be targeting this 12 or 24 months as the period when the company should have another round of financing, when third-party validation of the value of the business will happen. Conversion happens when the principal amount of the notes automatically converts into the shares with next financing. And these are the terms which you might come across in the papers. So it's qualified financing. Remember, I mentioned the case when it's either below 1 million or above 1 million financing the next round. So the qualified financing in this case would be the financing of cash in into the company of more than $1 million. Conversion discount and conversion cap, something we have covered. Just again, if the valuation will be X, it means that we will be converting our note into the shares of the same share class, actually, at a lesser price. So the discount will show us what price will be for us. The conversion cap is the maximum valuation, right, at which we will be calculating those equations. Qualified financing, usually it's the minimum amount of equity required for automatic conversion. Remember, it might be automatic or optional. And usually it's 1x or 2x of the principal amount. For you as a holder of the debt, there is no reason to give up this debt instrument, right, which actually provides you additional protection in the capital stack of the company. If the business demonstrates good development and became attractive for big enough investors. When the company become well capitalized, for you, it's okay to give up these debt characteristics and get these equity characteristics into the well capitalized business, because risks of bankruptcy or insolvency have decreased substantially. And actually, qualified financing excludes the situation when there is so-called sham financing, right? So no tricky around the situation. So that the founders do not agree with somebody who will provide $10,000 just to trigger this conversion from debt to equity of investors, right? So it will be true equity financing, right? Huge enough in comparison with the money provided through this convertible loans. Conversion discounts. The logic is simple. Note holder should receive a benefit relative to the next equity investors, right? Because he was bearing the risks while the new investors was not. Typical discount will be from 15 to 25. Again, it's subject to negotiation, but for you just to get the market practice. It may be higher in investments with more perceived risks, or because the note may have a longer maturity, or other specific circumstances. The conversion cap is the maximum value at which the convertible debt converts into the next finance round, right? It's regardless of the value agreed by the next investors and founders. So there is potential conversion cap. It fairly compensates investors when the outstanding notes convert into equity at very high valuation. Because what you get in case you don't have a conversion cap as an early investor through conversion note, especially today when the valuations are skyrocketing with each next round of some particular hot businesses, is that you provided capital early in the stage of the life cycle of the business. You have borne huge risks of failure. And then all of a sudden, Sequoia Capital or DST Capital come and provide a lot of capital at huge valuation to the business. And without this conversion cap, you just get a small fraction of the company after that round. So actually, you have been bearing the huge risks at the start. And just because the big players came and valued the business very high, you just get a really small fraction of that. So effectively, you're being diluted enormously, right? Or you're not fairly compensated. So conversion cap actually prevents that. So for you to be fairly compensated at very high valuations. Typically, the cap and discount operate in the alternative. So effective conversion price equals minimum defined by both. So actually, you have to apply both these things, the discount and conversion cap, and get the minimum. The size of the round and the conversion cap are the two variables, and each of them can have significant impact on the ownership position of investors after the conversion. They have magnifying effect. No conversion cap example for you. We have invested, let's say, together with other investors through conversion note. We invested 1 million, and we have to convert it with equity financing when valuation is 1 million. We will get roughly only 1% of the company, even though at the start the 1 million we provided was a substantial part of the balance sheet of the business. Should investor invest 1 million in equity instead of the note, he would have had around 20% of the company, right? So that might be the case. So should it be not convertible note but equity at the start, we would be bearing the 20% of the company. And now let's look at the conversion cap example. If the business raises a venture round at 10 million pre-money, but let's say your note have a 3 million cap, conversion cap, your note holders just got a 70% discount. So actually this cap already provides you with huge discount, Effectively, without having this liquidation preference things put on the paper, you have already got that more than 3 times, right? Because if you convert it into the same preferred stock, which just have been issued in equity rounds, but you bought those shares at 3.3 times cheaper, effectively you have this 3.x liquidation. Why? Because this share class, preferred shares, by default have 1x liquidation preference. You just bought them at huge discount. So effectively to your cost base, your liquidation preference is higher. It's just for you just to get the example. It's not very common, but it is a possible scenario. So again, no conversion cap will be diluted. If conversion cap is small, convertible note investors effectively get high liquidation preference. So in either case, one or other party will be disregarded or not in favor. So somewhere in between, the truth and balance of interest is somewhere in between. Convertible note has a repayment option, but in most cases, the note is not repaid on maturity date, right? Most probably, venture company doesn't have money to repay that note. However, everything is possible. Investor in most cases is not interested as well in the prospect of just making his money back with interest, right? You would probably invest in high grade fixed income with short maturity rather than providing money to venture just to get this money back. So effectively, initially, you just want to convert at later stage, but still you want to be an equity investor. At maturity, investors can elect to repayment or conversion at the pre-agreed price. It's divided. You calculate it from cap, or it might be low. The parties need to agree in advance on what kind of stock the note convert into at this maturity. Would it be common or preferred stocks? Of course, you as an investor want preferred stocks. When this maturity date is reached, the issuer and the investors may agree to so-called extend this maturity or keep the notes outstanding and due. So effectively, it's not repaid, you are due, it's not default, but the extension has not happened, right? So it's still flexible. It's not like fixed income. If you haven't paid, it's default and bad things. No, a little bit more flexible. As a note holder, you will receive upon the conversion the following number of shares. You will take the money you have invested. This money invested actually should include effectively any accrued interest. I will try to show it later. And you will be divided by the next series share price, right? So we have an equity round finally, we have a validation of the business value. We take this share price, but we have to apply the discount to that. So example, if we put 400,000 into a convertible note, in 1 year, company raises Series A financing with $5 per share. You will receive 100,000 shares instead of 80,000 shares, which you would have received as an investor into this Series A for the same amount of money. So convertible note holders will be compensated in terms of number of shares for the risk they have borne. In case we have a valuation cap, the number of shares might be calculated as the number of invested capital divided by this capped price. Where the cap price is a price per share, assuming the company has a valuation equal to the valuation cap, which is in the convertible note paper. So let's try to look at the example. 1 year ago, we as investor invested into simple agreement for future equities, or SAFE. It's used on early stage in accelerators, with 8% annual dividend. Remember, dividend is not something what is paid, it's something what is accrued. And there is a discount rate of 20%. The company later on has, and before that, has 5 million shares outstanding. And then qualified financing happens. Remember, if qualified financing happens, there is an automatic conversion of the note to the shares. And let's say it's the following. It's 3 million invested on pre-money valuation of 10. So the latest investor get 3 million shares, and we will get 67 and 500 shares. How we get that? We will divide 1,008. 8 is the percent, right, which we invested. And yeah, I'm sorry. Here's one small thing is missing. We have invested 1,000K into the business. So together with this accrual interest, it will be 108,000Ks. And if we have a valuation cap of 5, then we will get even more shares, because we will have to divide by the smaller price of the share, which goes out of this cap. So effectively how it works, you will get your shares, you will have more shares in comparison with the case when you invest the same amount of capital into the round, which triggers this conversion. But if in addition to that you have a valuation cap, then you might get even more shares, because this valuation cap works. And it effectively decreases the price per share, which you use to get the number of shares. Okay, I hope it's clear. Of course, as always, I will put that into the Google Classroom. I hope actually you joined that. Yeah, most of you have joined. We still have 3 people who have problems and 2 people don't know Google Classroom. Okay, I will make a small pause here. As far as you remember, you have provided me with the list of your names and emails, and I made a Google Classroom What is Google Classroom? It's the place where I'm putting the lectures and links and other materials for you to read, as well as the tasks. I have already, as far as I remember, assigned to read something, but soon you will get other tasks. So it is something, it's a platform for us to communicate. So those of you who still have problems, please try to connect with your colleagues who are successful in joining the classroom. Most have succeeded. I'm sure they will help you. And those who don't know about the Google Classroom, please also consult. In case you cannot solve it by yourself or with your colleagues, please write me a letter. As far as I remember, some people have wrote me already. I answered. So I hope you will manage to do that. With materials, please make it a little bit faster. I'm glad to see that at least half of you are reading the materials and maybe even have questions. But you will have to become a little bit faster in terms of reading and making things. And just read this Venture Capital and Finance of Innovation book. Remember 7, 8, 9, 10, just 4 chapters, not a lot, but they will provide you the big part of the things which you need to be successful in the course. And just a good book to read later on if you are interested in the field. Okay. This is for you just to see the results. I hope you see it. This is how you voted. It's 37 people, not all 50, but still the biggest part already. I'm glad you are here. So most of you have succeeded, some have problems. Most of you are reading the materials, but not everybody. And the book is just start it. I as far as I remember, I have provided the full name of the book. It is in the library of HSE. And I will make sure I provided you with the link to the web where you can get it as well. Okay, now let's look at particular selected deal terms as far as I promise you. So liquidation preference, how it would work. It's a little bit different to animal, but still important. So let's suppose the new company raises $2 million in funding, and the valuation after this investment is 20 million. And the next round goes at cheaper valuation. No, I'm sorry, not at cheaper valuation, but the next round goes at higher valuation, but not so much higher, and it attracts 14 million instead of 2 million raised in Series A. Both rounds were negotiated with a so-called liquidation preference 1x. And interestingly enough, the company was acquired for only 40 million, which was below the valuation in Series B round, which is quite often situation. And let's see how this liquidation preference impacts different investors. First case, liquidation preference is 1x. This is new company, and as far as you get, the original investment for Series A preferred round was so it should be 3 million, not 2 million. Original investment of in Series A round was 3 million. In Series B it was 14. So the effective ownership percentage after Series B investment is as follows. Series A has 10%, Series B have 1/3 in the company. Series A investment, of course, was higher before the Series B investor came, but as far as you remember, with each investor coming into the capital structure, the previous investors are being diluted. So actually 10% of Series A investment here is the effect of that dilution by Series B investors. Anyway, this is what we have. We have ownership after 2 rounds. We have original investments, 3 and 14, and we have the preference multiple, which gave us liquidation preference over the costs, right? So Series A investor should have received 3 million, which he invested. Series B investor should have received 14 million, which he has invested. The priority, which is the last column, actually says in this case, pari passu means that these two rounds are equal. So these share classes are equal in terms of liquidation. It simplifies the calculation in this case. It says that Series A and Series B investors altogether are higher in the capital stack than the common shareholders. So let's look at how it will work. Remember, we have preferred shares and we might decide whether to convert in common shareholders or whether to not convert. So each of the investors in Series A and Series B can decide whether he wants to convert it into 101 into common shareholders or not. Let's look at the situation. The company was sold exit value at 40, right? If both A and B do not convert, they will have free 14, and the common shareholders will get 23 million, right? That's the column in between. If all preferred shareholders will convert into the common, so we will have to split the pie according to the ownership, right? There is no any preference of shares A and B in front of common. And we will have 10% of exit value, which is 4 million for Series A. We will have 1/3 of 40 million, which is 13.33 for Series B. And common shareholders will get 22.67 million US dollars. As far as you understand, there is a point for Series A to convert because he gets more in both cases to the right. For Series B, there is no sense of converting that money, right? Because he will get only less or the same. So in this case, the Series A investor will convert his capital because he will get more than cost. Series B investor will decide to stay the same. And the common shareholders will get actually what will happen first, if only Series A convert and Series B doesn't convert, Series B will get his 14 million back, and the remaining capital, which is 26, will be split equally and proportionately among Series A investor and common shareholders, because now after conversion of Series A shares, they have the same shares, common shares, and we will get this split of the capital. So this is how this works. Now let's look at this at another angle, and let's say the preference is higher. So the deal is structured so that investors A and B can get at least 1.5 of their cost, and they still pari passu to each other, which means that A will have at least 4.5 and B will have at least 21 instead of 14. We have the same math here in the table below, but the numbers differ as far as you might see, right? Again, the right column is the same. Should all of them convert, they will be proportionately split. But there is no sense to convert for Series B as before, so he will not convert, right? And for Series A, it's also a no-brainer. He will not convert this time, because if converting, he will get only less in all other situations. So what we have here, we have that A and B will decide not to convert. Since it's not an IPO, it's just the buying of the company, the investors A and B will get 50% of the investments. I mean, 50% to the investments as a return, regardless of the timing. And only the remaining 14.5 million will go to common shareholders. So, yes, I'm sorry. Okay. Somebody just unmuted and I thought it was a question. No problem. Just write in the chat or don't hesitate to ask. So in a nutshell, as far as we see, the line with common shareholders is the most affected here, right? So should it be equal, should they be equal with A and B, they will get much more than being the last one in the chain. And this is how it works. Now let's look at the liquidation preference of free, which is really uncommon now, but it was quite common at the start of 2000. And our original investors, A and B, should return at least 3 times more to the investment, right? Which is crazy, I would say. The calculations will tell us, of course, that common shareholders will get nothing. This is the situation when liquidation preference actually has some leverage, effect of leverage on common shareholders, right? Series B investor will not convert, but neither Series A investor will convert. Because if he converts, he will get nothing because Series B will not convert for sure. And what we have in no preferred conversion section is that common shareholders get nothing. But given that Series A and Series B investors has pari passu priority, where they will have to split among themselves. So this 40 will be split among themselves. They will not get this actually liquidation preference amount. They will get slightly less, but no, not slightly less. I mean, Series A will get his even more, but Series B will get less. But should Series B investor be senior and Series A junior? So let's say the Series B investor has some preference over Series A. Then we will have the situation when Series B will take everything. It will be, he will take all 40. So as far as you see, these numbers, which actually in documents is just a 1 or 2 lines of text with this number, or even without number, it will be written just in boards. And this seniority actually affects a lot the final outcomes in terms of money in different circumstances. That's why the deal structure is quite important, and you have to take into account different aspects of the deal. Now let's look at the participation rights. This is the last thing I think we'll cover today, but also quite important. Let's take the same investors, Series A, Series B preferred. The ownership will be split the same, original investments the same, preference multiple the same. But let's say that these preferred shares are now participating. So they're participating into the company valuation after investors get their money back cost. In this case, as preference multiple is 1x, they will get the original investment and they will be proportionately participating in the remaining value of the company upon the sale. So let's say the participation cap is 5x and the priority is the same. A and B have the same priority among themselves. Common shareholders are junior to them. Let's get the scenario when the exit value is 75 million, not 40 but 75. So Series A and Series B will first get their preference, which is 3 and 14, right? And the remaining equity value to split will be only 58 million, right? Then proportionately, these A and B investors will participate, right? So in addition to what they got, 3 and 14, they will get proportionate share of the remaining value. So 5.8 for Series A investor and 19.33 B investor. And to common shareholders will get only the remaining part, which is less than 33 million. And to the right, you see that the Series A investor altogether will have out of this investor 8.8. Series B investor will get 33.33, and common shareholders will get 32.87. Altogether 75 from the deal. So you see the sequencing and of waterfall from the deal is slightly more difficult. If you look at, I tried to make it more familiar to you. So the sensitivity table, right? What we've done, we took 1x and the 75 million exit value. So let's say we take different values, exit values, and we change this preference multiple. So liquidation preference multiple, which we covered before. And Series A investor exit value will be looking like that. Right? So of course, the higher the valuation, the bigger he got. But also with value increasing, there is also an effect of this liquidation preference multiple. And this is for you just to look yourself. Always try to do that. But this is quite interesting aspect. Sequencing and priority and multiples on liquidation preference are quite important. The Series B investor will have more or less the same table, but you see it slightly differs. And for founders, for founders, it's not that awesome, I would say. So the higher the liquidation preference multiple, which is on the left column, the later they get the same amount of money, which is of course clear. Some note on anti-dilution protection for you. There is a quite famous company called Square, right? What they did, it's a payment company. They already pivoted in many other areas, but initially that was a payment company which allowed you to use cards with special thing and pay the bills and checks. Important enough, seniority capital structure disappears with IPO. If companies register stocks for an IPO, upon the IPO, right before the IPO, all the preferred stocks become common stocks. They are converted with particular conversion ratios, as we mentioned today, into the common stockholders, and then the IPO is happening, right? But there is a tricky side here. Price of the share right at the moment of IPO is very important because it might trigger issuance of new shares according to Ratchet formula. Remember that this anti-dilution and Ratchet formulas and like that. What happened with Square in IPO in November 2015? A year before, that was in late 2014, the company raised 150 million in late stage Series A round with price of share 15.46. These investors were protected by a ratchet that guaranteed them at least 20% return on the investment. So it was not in terms of multiple, this was in terms of IRR. So remember, this protection might be differently structured. In this case, it was in terms of IRR return, which actually takes into account the effect of time. The IPO price was lower than the target. It was $9 instead of the range of 11 to 13. The company was required to issue additional million shares to get the Series E investors back to the price per share, which actually guaranteed their return, right? So actually, 243 million was raised in IPO. The company received most of them. Selling shareholders got a little bit. 27 million shares were sold, so most of them by the company and some by selling shareholders. After this IPO, still invested into the company was JP Morgan, Khosla Ventures, very good company, Sequoia Capital, US Venture 2010 fund. That's just the name of the fund, but that was managed by Sequoia Capital, and even Visa. You see, this is about corporate venture. You see, these companies are trying to be in the businesses which are threats to them. Look, but shares of the company actually closes 45% up on the first day of trading, even higher than the upper bound of IPO range initially. But this $9 was enough to trigger additional issues of shares. So effectively, there was a dilution of the previous shareholders in favor of this Series E shareholders, right? It's just an example. Read on that, Google that. It's not the only one, but keep in mind, structure and the deals and all these things and all this liquidation preference, participation features, etc. It all have some devils in details. And in this case, the devil was that the new shares are being issued to the latest investors, So actually, they were provided additional shares, which in one day were up 45%. Not a bad idea how to get additional return, right, on the investment. Okay, dear students, it's all for today. I hope you liked it. I will put this lecture into the Google Classroom soon. Should you have questions, please try to find them in the lecture or in the book, or don't hesitate to write to me. Just for you to know in advance, next time we will have a short quiz. We should have done it actually a little bit earlier, but we will have it next time. So next time it will be a short quiz and a short lecture, or maybe not even short lecture. We will increase the number of hours. So it will be not 4, it will be 6 next Saturday. We will have 2 hours for quiz and 4 hours for lecture. And after that, we will have a couple of seminars. Moment, I have somebody in chat. Yes, it will be intermediate test. That's true. This is something I wanted to make even today, but I decided for you to give you more time to prepare, given that you were a little bit lacking with that. Partially due to my fault, but partially due to you being not very fast with reading books and materials. Anyway, I don't think it's a big problem, but I will ask the university to slightly change the schedule. Next time it will be 6 hours, so prepare, please. We will have maybe a longer break, and for you just to have some snack, and we will cover the remaining part of the lecture. And be prepared to have some time. I will put a lot of tasks into the Google Classroom. Again, those who are not still there, please make sure you are there. Ask your colleagues. Finally, if you are not capable of doing so, to reach me, but I'm sure you can do it. Just try a little bit, because most of those who tried, they managed. There was no problem. Thank you for visiting and listening. Appreciate your any feedback. I will stop demonstration, but I will leave the Zoom conference a little bit on. Feel free to chat something in, or I don't know, voice you want. And take care, and bye-bye.